The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
China economic stimulus outweighs flagging U.S. consumer confidence as the global market rally keeps on keeping on. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. 41 record highs.
Oh, I
that
thought
would
you
be
were saying
today.
41 days of Christmas or something.
Oh, no, but that's not it. But that would be fun, too. All right, so if we close at a record high, as we're looking at for the S&P, it would be the 41st record high so far this year. Again, on relatively light volume, guys, nothing really moving the needle except for tech, of course, doing really well. That's actually an NVIDIA story. We'll get to that throughout the last 2 hours. And that curve, and this is a great example of what Romaine's going to talk about in terms of that economic data, the consumer confidence data. The curve continues to steepen, but off the highs that we saw earlier.
Absolutely. Here, when we talk about what's really been underpinning this market here and really around the world, it really has to be China and the central bank there lighting a fire today under investor confidence worldwide with a broad package of monetary stimulus to revive the world's second largest economy. And while there was some skepticism around the initial announcement, investors by day's end had warmed to the gesture, pushing the benchmark CSI 300 up 4%. For its best day going back to 2020, that rippled over into European markets and here into the United States as well. But, and there's always a but, U.S. investors do have to reconcile the good news out of China with concerning news right here at home, where consumer confidence unexpectedly fell by the most in 3 years. Why? Well, regular folk showing fresh concern about a labor market slowdown and still holding on to old concerns about the persistently high cost of living. Now, that consumer confidence figure, along with the deeper than expected contraction in the Richmond Fed's manufacturing index, that's a big reason why you continue to see the Treasury curve steepen. The spread on selling 2-year notes and buying 10-year notes now at the widest since at least June of 2022. That should be a good thing. But I guess it depends on exactly which part of the curve, Alex, is being bought and being sold.
It's such a good point. For the last couple of days, we saw that back end being sold off, yields a little higher. And now we've seen that front end now come down as we worry about some growth concerns. And this was, again, what we saw after we got that consumer confidence data. This is the world implied probability for interest rates for the Fed. You have the yellow part is what we're going to see for November. At least that's what markets think. And the blue is what you might see for December. And you can see how we've really moved the cutting needle here. We haven't seen these kind of cuts priced in since earlier in this month. You're looking at potentially now 37 basis points of cuts in December and as much as 41 basis points of cuts now in November. You're looking now at over 75, which would imply one more jumbo cut remain. Absolutely.
Let's kick things off to the close here on this Tuesday afternoon. Subadra Rajappa, head of U.S. rate strategy over at Societe Generale, joining us right now. And Subadra, when you take a look at the moves that we've seen in yields over the last few days and weeks here, what exactly is being priced in your view?
The market's definitely pricing in a very aggressive policy path between now and the end of the year. We're looking at nearly 50 basis points of cuts at the November meeting and perhaps another cut at the December meeting. So it's an outlook towards front-loading these cuts. Really, the main takeaway from the last FOMC meeting is that the Fed wants to front-load cuts and they want to move away from restrictive policy as soon as they possibly can. And that's why I think the market is inclined to price in nearly another 50 basis point rate cut at the November meeting, even though the Fed has told us that they're only going to deliver a total of an additional 50 basis points by the end of the year in the summary of economic projections.
Does it matter that, at least right now, it appears more investors are still embracing the shorter end of the curve rather than extending duration and buying out 10-year, 20 and 30-year notes?
Yeah, I mean, when Fed rate cuts start getting priced in, it's more of a front-end phenomena. So that's why you're seeing the 2-year rally as much as it has today. But once the Fed starts cutting rates, as they cut rates, that's somewhat stimulative. So you should start seeing higher inflation expectations, higher term premia, and that causes the yield curve to steepen out. So you're seeing the 2-cents part of the yield curve or the 530s part of the yield curve steepen out because of front-end yields declining as well as long-end yields rising. So this is a very unusual type of price action in the bond market.
Yeah, and that's what we sort of are flipping between. Like, I feel like at the end of last week, maybe we get those jumbo cuts, we see inflation, we see growth come back, and you saw the long end sell off. And now again, it's the front end as the data might come in a little weaker. How do you manage that kind of dynamic?
Carefully and patiently. I mean, our view is that the front end at least seems to be very efficiently priced in for a very aggressive policy path. You're looking at, as you mentioned, Alex, at the beginning of the show, you're looking at more than 75 basis points of cuts for this year. The market in aggregate is looking at over another additional 200 basis points of cuts between now and next year this time, after the Fed has already delivered a 50 basis point rate cut last week. So this is a very aggressive policy path that the market's pricing in. This is not what the Fed has in its summary of economic projections. In its summary of economic projections, the Fed is looking at maybe 2 more cuts for this year and a cut per quarter for next year. So it's going to be really interesting to see if the Fed moves towards the market or the market moves towards the Fed, if the economy actually starts to improve.
I mean, hasn't the Fed always really moved to the market, whether we want to think so or not?
Not really. I mean, during the rate hike cycle, they've very masterfully got the market to price in the hikes that they wanted to deliver. And this time around as well, I think, by way of Fed speak, they've been able to convince the markets that they could deliver a 50 basis point rate cut in September. And the market was almost nearly fully priced in for that. So, I think it goes both ways. I think that if given how strong the economy has been that far, given the fact that they've engaged in preemptive rate cuts, I think that if they do act decisively between now and the end of the year, that's actually going to be somewhat stimulative to the economy.
What's the main risk, though, Subadra, that you're keeping an eye on?
It's how the market reacts to once the Fed rate cuts are delivered. I mean, if we do see an increase in services side inflation, if inflation starts becoming a concern, that's something that we're watching. Heading into the elections, we'll be watching to see what the outcome of the elections are. I mean, the last time when we had a presidential win from Trump as well as a sweep from the Republican Party, what we saw was higher inflation expectations and steeper curves. So the elections, again, could be something that plays into the price action in the bond market.
Yeah, funny though, Subadra, Moody's said today that the next U.S. administration must grapple with the widening budget deficit or kind of risk the backlash from the rating agencies, right? And it's like either way who wins, though, can you just see that front end yield continue to climb because we're just going to have bigger budget deficits and the need for more money?
Yeah, no, the front end is definitely going to be pegged to Fed expectations. Where we can see yields rise is in the long end. I think that you could see higher 10-year and 30-year yields if we see the trajectory for debt and deficits getting worse from here on. So if there's going to be perhaps more tax cuts coming and no meaningful way of paying for those tax cuts, then the market's going to very quickly recalibrate to a much higher fiscal trajectory. And that would mean much higher long end yields.
All right, Subadra, great stuff and great to catch up with you as always. Subadra Rajappa, head of U.S. rate strategy over at Soc Gen. Your 2-year right now camped out around 3.5%. Your 10-year at 3.7 here. Yields across the curve right now slightly lower here on the day. When we come back here on the big program, the CEO at Novo Nordisk feeling the burn. Senator Bernie Sanders telling him to stop ripping us off in a tense Senate hearing about the high price of their weight loss drugs. More on that up ahead.
All right, plus Ørsted is one of the world's largest renewable energy companies. We're going to talk to their CEO about opportunities in alternative energy and whether we've blown past the worst of the slump in wind power profitability.
I love those glasses. And 3 of the fastest women in the world will be joining us to talk about a first-of-its-kind race that will see 3 female sprinters competing for a record-breaking prize purse. You don't want to miss that conversation. All that and so much more coming up in a bit. This is The Close on Bloomberg.
Products that comes with a low list price get less coverage, it's less attractive, less patients have access to our medicines when we have lowered the price. I understand that perhaps the PBMs have changed their mind, and I'll be happy to to collaborate with them on this, because anything that helps patients to get access and affordability, we are supportive of.
That was Novo Nordisk CEO testifying before the Senate on the cost of weight loss drugs. Joining us now to discuss, Evan Seigerman, senior research analyst at biotech and pharma equity research over at BMO Capital Markets. He has an outperform rating on Novo Nordisk ADRs. All right, did Novo Nordisk do what it needed to do? Did Lars do what he needed to do today?
I think Lars did a fantastic job. The questions were tough, but he highlighted that they're just working in a system that other folks have created. I almost got the sense of Lars was saying, we don't have those issues in Denmark. I'm working with the system of PBMs and insurance companies and list prices and discounts and rebates and trying our best. Clearly, there's more that can happen, but we need all the players to come to the table to start to really come up with a solution, including the PBMs.
I mean, yeah, blaming somebody else, though, is always pretty easy. What was the response? Like, clearly he's talking to Bernie Sanders. Do you think that it's done now?
I don't think anything with Bernie Sanders is done, right? This is weight loss drugs and diabetes drugs are a hot topic, in Wall Street and on Main Street. I think that it highlights the nuance. And I know, you don't want to shift blame, but our healthcare system is super complicated, right? PBMs really like high list prices because they get a cut of the rebates and the discounts. And that's why he brought up the example of, discontinuing some of the insulins that were discounted because the PBMs didn't want to carry them anymore. So there's clearly a lot of friction in the system. They are willing to work with all the constituents to make it work better for patients.
So I am curious, though, Evan, on this whole idea of pricing and sort of shifting the blame to the PBMs. If Novo basically decided that it did actually want to lower the prices, there's nothing really stopping them from doing that. I mean, there's no indication that the PBMs would have any real pushback on that, is there?
TBD, because PBMs, as I said before, make their money on the spread from the rebates and the discounts. So they like high list prices because they can then negotiate it down. So Bernie Sanders did say that PBMs were willing to provide more open access if Novo were to lower the list prices, which they could. Ozempic, for example, is a couple of $100s per patient per month once you figure in those rebates and discounts. But it feels a little bit of like the fox is guarding the hen house here, not to use an analogy like that, but that's the sense that I got. And I know I'm biased as I'm a pharmaceutical analyst, but still.
Yeah, no, I feel you. I mean, I think we're all on the same page, but it gets to also the idea of the natural evolution of the drug market, at least here in the United States. The idea that when you have these branded drugs, particularly a blockbuster drug that treats something very specific, you always start out at this high price point. Eventually, those makers eventually start to give a little bit on price. Then all of a sudden, you get the knockoffs, you get the generics come in, and then the prices get down to a more reasonable level. Is there any way or any reason to think that that's not going to be the same trajectory?
Well, I think our model assumes that the price of semaglutide products, so Ozempic, Wegovy, and Lilly's products, Zepbound and Mounjaro, go down over time. Mm-hmm. What's key here is that Lilly and Novo have this manufacturing advantage, which is going to be their secret sauce later in the decade, and they'll be able to compete with generic manufacturers on price. If they're selling, Wegovy for $300 per patient per month in 2030, it may be very hard for a generic manufacturer to compete on that, just given the expense of setting up a line and actually getting the product made. The whole $5 per patient per month isn't actually true.
That's interesting. So actually, with Eli Lilly, do we expect the same issue to be at large for that company as well in terms of Bernie Sanders?
TBD. I don't know if Bernie Sanders and the Senate are going to pick on the hometown hero of Lilly. I'm sure Dave Ricks would love the opportunity to talk about drug pricing and express his view on the PBMs. But TBD if we have that ahead of the election.
Evan, just real quickly, I am curious about where we stand with the development of these alternative drugs, or competitors, I should say, rather. We've been talking a lot about some of the other potential drugs that could come to market, including different delivery methods that might actually make it a little bit more palatable to certain folks who want to take it.
So what's super interesting is Lilly is actually on the forefront. They have phase 3 data coming for orforglipron early next year. I know there's a lot of talk about the compounders. I really don't think that's a great way for folks to get access to these drugs. We don't know where the active ingredient is coming. But Lilly and Novo are really at the forefront. Roche did have some data earlier in September, but we may have some of the best products available now, and Lilly and Novo are the ones that are going to bring these forward and make them better.
All right, Evan, great stuff, man. And really appreciate you taking time for us. Evan Seigerman there. He's Senior Research Analyst of Biotech and Pharma Equity Research over at BMO Capital Markets. A closer look at the Novo Nordisk CEO on Capitol Hill today. Meanwhile, down in Washington, Merrick Garland, the Attorney General of the United States, holding a press conference, this after suing Visa, the DOJ accusing the company of antitrust violations. This is an interesting story here, and we see those shares down 5% here in the cash session. This is basically he's saying they violating at least two different acts, two different parts of the Sherman Act here. And this is actually interesting, too, because this is probably the most forceful use we've seen of the Sherman Act in an antitrust case during the Biden administration in the 4 years since Biden's been in office.
So Bloomberg Intelligence had a reaction to it that said that it wasn't a surprise because they've been investigating debit card practices for a bit, but it does have headline risk, but it could take years to settle this kind of thing. We have no idea what kind of headline risk that would entail, so don't get too excited about it, basically.
And not only years, but usually the outcomes of these. I mean, we always talk about the Microsoft example. They went in for years as a punching bag, and then the net result of it, they ended up as one of the largest companies in the world. But to this point, though, on this debit thing, I mean, think about how many companies have been trying to find workarounds to this whole, let's call it what it is, kind of a monopoly or duopoly, if you will, here. And they've been looking for ways around it, and some have found ways around it. So maybe you need changes in the law to facilitate that rather than just lawsuits against Visa.
Yep, but if the White House flips and we go in a different direction in November, like come January, forget it. Are we going to still have the same case, or does that change?
How many days until the election?
I don't know.
Days until the election, days into Christmas. These are the most important things.
Is it 41 or 42?
Well, last before I went on my Outback adventure, it was 47. So I guess it's 1, 2, 3, 4, 5, 42.
There you
I may
go.
be right, I may be wrong. Anyway, when we come back, we'll give you an update here on how many days left to the election. We're also going to give you an update here on car parts. Consumers aren't in the zone for car parts. That hurt my soul a little bit. Next in our top calls, we're going to recap AutoZone's quarterly report and same-store sales miss. That's coming up next here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls. The big movers on the back of analyst recommendations. And we start off today with Salesforce. Piper Sandler raising its recommendation to overweight from neutral. The analyst saying margin leverage and share buybacks could usher in double-digit free cash flow growth for the next 3 to 5 years. Investors like what they heard. They're boosting the shares by about 1.7%. Next up, let's take a look at Starbucks. A rare sell rating for the coffee chain. Only 2 sell ratings on this stock now. This one now coming from Jefferies, which cut its recommendation from hold to underperform. The analyst calls the upside market reaction to Brian Niccol taking the helm as CEO overdone and tells investors execution will be challenged as issues like ops, culture, value perception, and tech take time to fix. Those shares down for another day, down by 0.7%. And finally, a downgrade to hold from buy for Costco. Truist analyst Scott Ciccarelli expecting changes such as scanning IDs upon store entry and packaging changes to products, adding sales friction. He also says the stock's valuation is stretched a bit and urges investors to seek a more attractive entry point. Maybe they get one today with the shares down about 2%, 8.98 even right now on Costco. And those are some of our top calls. We now want to turn our attention to the world of auto parts and the world of AutoZone. The share is slightly lower here on the day after the auto parts retailer missed the mark for some same-store sales. Its CEO saying that the business and its conditions continues to be challenged by deferrals across our discretionary merchandise categories. Joining us now to talk a little bit more about this is Greg Melich. He's Senior Managing Director at Evercore ISI. He's got an outperform rating on AutoZone shares. What exactly does deferred discretionary spend? Because I always looked at AutoZone as being a little bit more of a staple, at least for folks whose cars break down.
Well, look at it. There's a staple, but a staple's maintenance and repair of that vehicle fleet and that car. That is a little over 80% of their sales, but the discretionary part of their sales fell basically to around 17%, which is historically pretty low. So what you're finding is consumers are not making that extra discretionary purchase. And even in some cases, trading down the products that they're putting on their cars, if they might be 10, 15, 20 years old, or choosing to only do 2 brake pads instead of 4. So people are under pressure and they're trying to find ways to save money.
Go ahead.
Sorry, but how does AutoZone combat that there? Is there something they can do to sort of get through this cycle without actually losing a ton of profits?
Well, they continue to grow their profits and their earnings per share. So I guess what this is, you sort of manage through it over time, make sure that you hold market share, and be there when consumers are ready to come back and repair their cars at the rate that you're historically hoped to expect. So what they've seen in the past is a more normal 2 to 3% comp in a normalized world. But the last few quarters and just this past quarter that they reported, it was only 0.2. And I think it's just a sign of that we've had sort of rolling recessions across retail the last couple of years. And now if people are spending on back to school, they might need to save some money in some other areas, such as fixing up the car 100% perfect this month.
But I thought that the whole Fed cutting rates thing was going to just totally help this kind of industry. So does that mean that this is the trough?
Well, rate cuts could certainly help to the extent it frees up, gives consumers a little more spending power. But the reality is with cars, and especially in the auto aftermarket, cars are very hard to afford, even if interest rates come back below 6% or on a mortgage rate, but even below, the Fed gets below 5%. An average selling price of a new car or a used car is up 30% from where it was pre-COVID. So just having a car is taking up a greater portion of income. Therefore, the average age of cars is now over 12 years. And so, what people decide to make that big fix up on a car, what they're finding, and you're seeing it in tires and some other areas, they're deferring where they can.
So, Greg, how do you play the trough, though? Like, what's going to be the stock that's best poised when we do wind up sort of moving to the upside?
Yeah, look, I think if there's a V-shaped recovery in overall retail consumer, you're going to want your more beta trade, big ticket consumer discretionary stocks. I would even say, like a Home Depot or something would be better positioned for that. That's not the kind of recovery we're expecting. We're expecting a more V-shaped or U-shaped or L-shaped sort of tepid recovery. And that's where we actually think auto parts is in a pretty good spot because people could have a little more money in their pocket going forward in 6 or 12 months. But we don't think they're going to go off on a splurge and spending willy-nilly, just given some of the affordability pressures.
All right, Greg, appreciate it. Thanks very much. Greg Melich over at Evercore ISI joining us on that. It does raise the question, Romaine, that sort of long and variable lags to the up and the downside, right? You had the lags on the hikes, you're going to have the lags on the cuts.
Yeah, absolutely. And I am curious about this because I always thought companies like AutoZone were a little bit more recession-proof, right? Mm-hmm. But I mean, it makes a good point. There is still a lot of discretionary spend there, and I guess maybe we are seeing that weakness. So,
and sort of the trade-off, like back to school versus tires, and then eventually you go to the tires, but it's still going to be a slow slog on.
How about something for my car?
What'd you get?
I like a little roof rack to put the skis on.
Oh, okay.
Yeah, so that's discretionary.
Good job.
I know, I'm doing my best to boost this economy.
That was really nice. Do you have skis?
Yes.
Oh, where do you hide them in a New York apartment?
Oh, well, that's a cute. It's called storage units, Alex.
Yeah. All right, fair enough. All right, coming up.
My second rent.
A conversation with Mads Nipper, President and CEO of Ørsted, about the physical and financial infrastructure needed for clean energy. This is The Close on Bloomberg.
I come back to my experience in India a few days ago. I went to a wind farm. 100% of it was built and sourced in India. It wasn't imported from somewhere. So if it can be done in one place, it can be done in another.
Lord John Brown there, General Atlantic Chair and also the co-founder of Beyond Net Zero. He was speaking a little bit earlier on Bloomberg Surveillance. Romaine Bostic here along with Alex Steele. Of course, this is big UN General Assembly week, also Climate Week as well. So a lot of great conversations going on right here on Bloomberg Television and radio about, I guess, the state of our climate and what we're doing to address these issues?
Yeah,
I hope so. I know you were over there,
yes.
The Plaza and a few other forums.
Yep, I was all over the place. And there are tons of different forums that are taking place. But the idea is you bring a lot of thought leaders in and you talk about the problems and how to do it economically and how you actually do all of this profitably. So if we stay with that and green energy, you got offshore and onshore wind is a big part of that story. President Joe Biden laid out a target in 2021 of deploying 30 gigawatts of offshore wind capacity by 2030. Higher inflation, though, and rising interest rates over the past few years created big headwinds. One company at the center of this is Ørsted, and CEO Mads Nipper took over the company at the peak of the green energy bubble in 2021, and it's been a rough ride since then. Joining us in the studio is Mads Nipper, President and CEO of Ørsted. Mads, it's great to meet you in person. It's great to have you here. Thank you for joining.
Thanks for having me.
You've implemented a tough turnaround. It's been a tough few years.
Yes.
What is the confidence level that you have that the worst for the offshore wind industry is over?
I have a good confidence level that the worst is over. I mean, we are seeing a maturing supply chain. It is still a supply chain that faces bottlenecks but it is maturing, and we are seeing markets like the US, which literally were built from scratch. We are also seeing that scale up, and we also see generally how the 7.6 gigawatts that we are building around the world, so roughly count on a gigawatt powering 1 million homes. That's a lot of offshore wind, and that is going much better. So we're confident.
Here in the U.S., where you had to cancel some projects and take some write-downs, a big part of that is you sign these off-takes, right? And people pay you for a certain amount for power, but then you're exposed to the commodity costs until you actually build it and deliver that power. And that's where everything got a little funky. How do you solve for that funkiness?
Yeah, let me say that generally, the entire renewables industry, and not least offshore wind, which is a longer sort of, it has a longer life cycle because they're very big infrastructure projects, got hit by these completely unprecedented circumstances with long interest rates spiking, very high capex inflation, and that hit the entire industry. And because we were the biggest and are the biggest in offshore, we got hit pretty hard with that. And what we do is we move on, saying the things we could no longer invest in, we stopped. But the other things, such as the Revolution and Sunrise wind farms outside of New England and New York, which are progressing well, we built those, and we see that going to plan.
There was still a lot of pushback to that, community pushback, political pushback as well. How do you navigate that? Because when we talk about renewable energy in this country, I think the one that seems to create a lot of divisiveness, at least among community members, are windmills, basically wind power. How do you address that?
Well, we are deeply committed to a positive community engagement. So we engage with all stakeholders. So not only our customers, which is typically states, or in the sake of onshore, typically large corporates or utilities, but we engage deeply with them in an open dialogue. And I'm encouraged to see that the broader support, there are still people who don't like it, but the broader support due to energy security, not least due to job creation. And it's dawning to more and more of our stakeholders, and we're actually creating jobs literally across the country in this, and that helps.
At the federal level, you've had a little bit of wind at your back, pun intended, by the Biden administration, which of course has made this part of a huge package of renewable energy plans.
Yes.
It's possible, well, we know we're going to get a new administration, but whether it's an extension of the Biden administration or a new Trump administration, does that worry you?
It is very clear to me that there's a broad support for renewable energy. So the bipartisan support to the job creation, to the energy security, is something that we feel quite comfortable with. And just as an example, our renewables portfolio in the US now is creating jobs in more than 40 US states. And seeing also how we, as Ørsted, has been facilitating that the first service and operations vessel built in the US is now coming online, is built in Louisiana. Those things open the eyes of saying, okay, this is actually attractive. And I'm encouraged to see that 18 Republican congressmen sent a letter to the Speaker saying, please ensure that the support for this industry continues.
So wrap it all together then. How do you value how much a wind farm offshore is worth right now when there are a lot of variables?
Yeah. So at any given time, we assess what is the return of that investment that we make. And this is something where obviously the offtake price means a lot. Also the long what are our expectations about the longer power prices when that offtake agreement runs out. And then essentially it also hinges on the interest rates, because the fuel of renewable energy is capital. And therefore, the interest rates also impact the return on that.
Have you noticed like an immediate impact from the interest rates moving lower already here in the U.S.?
Yeah, we don't speculate on what the long-dated interests are, and it's obviously not our decision. So what we do is we focus a lot on how can we build as cheaply as possible, how can we mature a local U.S. supply chain. But when those interest rates start to go down, it does impact the profitability of those projects.
With regards to energy generation and the end uses for that, there's been a lot of talk about the power demands of artificial intelligence and data centers. Microsoft just struck a big deal to effectively restart the 3 Mile Island nuclear facility. Are you getting any, benefit from this embrace of AI and new data centers?
Yeah, absolutely. But we see across the US, there is an increasing power demand. And most of this is desirable in terms of being green power. So when we see, for example, artificial intelligence driving a sort of an exponentially increasing power demand, especially our onshore business is benefiting from that. We see that the power price levels goes up because of that demand, and that of course is attractive. That is not yet a big power demand driver in offshore, where we typically have the states where we build as the customers.
Right, because you got to get it to the onshore, you got to plug it in and the whole thing. Before we let you go, a lot of your value comes from building a project and selling stakes in that project. What are those conversations like right now in regards to offshore wind in the U.S., and who are some of the players that you're talking to?
Yeah, so the reason why we sell typically as a standard model, sell 50% of our big wind farms. We keep them and we operate them until the end of their lifetime, but the reason why we sell the 50% is then we can recycle that capital into accelerated investments. And we are talking to some of the big infrastructure investors. I'm not going to name them, but those are people who are deeply interested in having partners like Ørsted who also have skin in the game. So we do not sell on a wind farm. We keep 50%. They know that our 50% and the fact that we operate it gives them a great partner. And that is why we have a big interest in actually acquiring that 50% also for our US assets.
Are the investors receptive to the terms of those deals? And if so, what types of investors are we talking about? Are we talking about primarily in the private space, or are you also seeing more support from public investors?
No, it is typically in the private space.
Yeah.
So it's a large infrastructure funds to a large extent, and those are companies who both have the capital, but also given that we can offer them different assets with a different risk profile depending on how early we are in the construction, something our partners find really attractive.
All right, Mads, really appreciate you stopping by. A great conversation here with Mads Nipper. He's president and CEO over at Ørsted. All right, coming up here, we're going to take a closer look at what's been going on over in China. The CSI 300 notching its best day going back to 2020. We're going to break down the moves in China's equity markets on the heels of that big stimulus coming out of Chinese central bank. That's our stock of the hour, and it's coming up next right here on The Close on Bloomberg. All right, time now for our stock of the hour, and we're turning our attention really to the broader basket of Chinese equities because they are back in a big way. This after the country unleashed a wide-ranging monetary stimulus package. Bloomberg's Abigail Doolittle joining us right now to talk a little bit more about this. You see the CSI 300 up about 4%, and those are kind of indicative of the gains we saw across the board for Chinese benchmark indices here. What's going on?
So best day for the CSI since 2020. That's the degree of the buying power, and it has to do with this big stimulus package. A bazooka, if you will. It reminds me of going back to the ECB back in 2012 when it was just so much stimulus. But it really was wide-ranging. So the two most important pieces were the fact that they cut the key short-term rate, but then they're also planning to reduce the reserve requirements for banks. So those are the two big pieces. That's the first time they've done those two pieces together since 2015. And then on top of it, some other measures for the property market, requiring lower costs on lots and lots of mortgages, easing rules for second home purchases. They created a $113 billion bank stabilization fund. So all of this stimulus, the question is, why? So is the Chinese economy, is it really faltering? Are they just trying to create confidence? Because something that really...
And I'm going to assume they didn't actually provide that answer.
No,
the data kind of speaks for itself. No, I mean, the
data?
the economy has been really not in great shape.
Actually, I'm with you, Ramin, on that. It's hard to know.
You talk to people from the ground and stuff, people who've been there and they're like, it's not good.
Yes, agreed. I have a few contacts who have said the same thing, that it's really tough when they go over there, and that it's actually worse than what our reporting would say, which I guess maybe is supporting what we're thinking about the data. What's really interesting here is, so the U.S. stocks, the HXC, China Tech, right now up about 9%, the best day since 2022. You have some of these stocks up more than 10%, a lot of them actually, the China Tech ADRs. In terms of what's going on here, though, U.S. stocks, though, up 0.2%. So I guess the point I'm making is you have all of this stimulus going into the Chinese economy. in times past when China has stimulated, it's lifted all, it's lifted European stocks, U.S. stocks, but that's not happening. So it's not seen quite as broad as that.
Well, there's also kind of that lagged effect, too. I forgot who it was, but there's a great story in the Bloomberg that talks about M1 money supply and how much China was a contributor of that pre-pandemic on a global basis, and how that just fell off a cliff during the pandemic and has never recovered. And the idea is that if that comes back up, that boosts the whole economy. And I think the great example that the reporter gave was when you looked at the last U.S. recession, it would have been a lot worse if you took out a big chunk of the Chinese M1 contribution to M1 supply.
Interesting. Yeah. Well, I've even had debates with people whether or not the U.S. is the number one economy, that maybe China unofficially is actually the number one economy, but either number one or number two. Yeah, I mean, it's a big piece of the picture. What's so interesting?
Be careful. Don't let Trump hear you say that.
I know.
I will deported or something.
I'll keep that quiet. Yeah, okay. But, it's interesting, this divergence that we also have between U.S. stocks and China stocks. The CSI 300 over the last 4 years, down about 40%. The S&P 500 over that time period, up more than 60%. So that's a massive divergence between the world's two largest economies, no matter how, which one is first or second. Let's say the U.S. is first for the sake of this conversation. Is this going to lift that? And a piece of the downdraft for them was the regulation a couple of years ago from President Xi.
Yeah. All right, Abigail, thanks a lot. Really appreciate that. Abigail Doolittle joining us. Do want to point out, though, the European stocks did end the day up over 1%, and you have the materials really outperforming as well here in the U.S. Best performing stock or sector within the S&P. All right, coming up, 15 minutes away from the closing bell, Kimberly Forrest will be joining us. Her take on the markets.
The market in aggregate is looking at over another additional 200 basis points of cuts between now and next year this time, after the Fed has already delivered a 50 basis point rate cut last week. So this is a very aggressive, policy path that the market's pricing in.
Subadra Rajappa there, head of U.S. rate strategy over at Soc Gen, kicking us off to the close just about 50 minutes ago, 10 minutes until those closing bells. Green across the screen for U.S. equities, so modest gains here on this Tuesday afternoon.
Yeah, but interesting to see what's leading it, right? You got S&P Materials leading it. Freeport-McMoRan Copper and Gold is the best performing stock in the S&P. Sure, Raymond James upped its price target, but nevertheless, that feels like a stimulus story that's coming from China. And NVIDIA had a nice turnaround in the middle of the morning there that really wound up helping leave the NASDAQ higher as well and outperforming. But on the whole, on an index level, it's a little boring.
Yeah, a little bit boring here. And of course, you take a look at yields. Yields slightly lower here on the day. The VIX, though, is being squashed down as well. So maybe that's a little bit of good risk appetite back in the crypto space, with Bitcoin right now around 64,000 and change. Kim Forrest joining us right now. She's the founder and chief investment officer over at Bokeh Capital Partners, with just about 8 minutes to go until we get to those closing bells here. And I am curious when we talk about the idea of that tech trade, Kim, the idea of a tech trade that I think, it must have been a week or two ago, everybody said was dead. We're all rotating into industrials and utilities and other stocks here. Is there life in that tech trade, particularly life beyond just NVIDIA?
Oh, gosh, you'd hope so. You really hope so. No, I mean, this, as you pointed out, not much is happening today. But I think every single day, investors wake up and say, is the AI trade done or not? And I think part of it is we don't have a natural kind of answer for that in, here are the top 10 AI platforms that are bringing in tons and tons of money from people willing to trade money for their services, because we're just in the building out phase of AI. This is the big question, though. How big are we going to build out? How many companies need to build out? And no one knows. So we're looking for little answers. Tomorrow we'll get one from Micron to see if that company does sell into the AI chain, and to see how their fortunes are faring and what they have to say, more importantly, about the forecast going forward. So that's the big thing. Is AI still a thing? And I think the answer is yes.
Well, it gets us to the point here as to where you put your money. If you do believe, have that conviction, where do you put your money? Do you stay with, obviously, the granddaddy of them all, NVIDIA, or maybe the grandbaby of Microsoft, if you will, here? Or do you look for something maybe that's a little bit less trodden?
I think you need to take a diversified view, even in this, right? So a little bit of money here, a little bit of money there, because we know that NVIDIA is a clear winner for, let's just say, the next 3 years. It's very difficult to design and then make these chips and then talk the people who are buying them into using them. So it is a really tough slog. Now, I do believe other chip manufacturers are going to win part of NVIDIA's considerable percentage that leadership, but it's going to take some time. In the meantime, there are other ways to play AI, and I'd be looking for that killer app, whatever it is. And so software is an area where I'd be looking constantly. And I don't have any tips for you because I don't see any clear winners.
No, fair enough. Hey, Kim, that was one sort of narrative of the market when it took to NVIDIA really moving the NASDAQ higher. The other is what we saw out of China and the stimulus from the PBOC. And it did lead materials higher. It did lead Freeport higher. It did lead some European stocks higher, which it says is that a cyclical trade. Do you buy into that kind of trade?
I do, but I don't personally, because I'm not a fast money in, fast money out. China can reverse what it just did, and it has in the past. These are all political moves. They're trying to make the population comfortable and wealthy and all that kind of good stuff. And, for the longest time, they've shut off the financial taps. They're putting them on right now, but who knows when it's going to stop. And it's just an area that I don't really want to play in because I don't want to pay attention to political matters in China, to be honest.
No, fair enough. But then when would you then, in a broader sense, like the cyclical exposure to the equity market here in the U.S.?
So, I think I'm beginning to anyhow, because our interest rates are falling. And the natural winner of that is first home improvements and then home building. People have to borrow to do large projects. That's just the way our money works right now. And I think that the easing of interest rates, whenever that starts showing up in a more material way in mortgages and second mortgages, the HELOC things, I think people will spend more. And that should drive some of the same materials as we're seeing that bounced on the China news.
Do you have confidence, though, in this idea, this narrative that's taking shape, that the Fed has finally got it right, or at least caught up, the idea that there's a soft landing coming, the idea that this economic malaise, if you will, that we thought was here was maybe a little bit overreaction?
I do think we are in a soft spot. There's, just drive around, talk to people. It's a soft spot, no doubt. And I think time always is a great healer of this, but so are interest rates. Mm-hmm. And I do think that not only did the Fed kind of call it right or right enough, but also businesses are just more well-positioned to be able to understand what is happening to their business and take effective action more immediately than they ever have been able to in the past. Having CRM software that shows them that their pipeline is softening lets them stop hiring people before they've made mistakes, right? And the same thing about laying people off. If they see demand coming back, they're not going to lay people off. And I think good software in the hands of people that want to not have to hire a bunch of people and then fire a bunch of people is working. And I think it's an untold story that I think is one of the drivers of the soft landing.
And we've also seen a lot of this show up in some of the earnings reports as well as some of the CEO commentary. They're clearly looking at data this cycle that maybe they didn't have in past potential recessionary cycles where they were kind of looking at outdated data, if you will. This gets to the question, though, if these companies can see what's coming and assuming they have competent enough management to address that here, do you have any worries about any sort of meaningful profit recession? The idea is that, do you think there is enough wiggle room for these companies to react to preserve some degree of profitability and margin?
I do. Companies are smart about that. They're not, unless they're in desperate means, right? They're not going to cut the bone and they're going to try to cut fat. Or they'll just sell less they don't want to sell more at a less profitable or an unprofitable stance. And that's kind of where you get into a recession, is when you're just trying to clear the shelves because you know that you need to raise the cash. So because of those metrics that they use now, I don't think they're going to be pushed to the wall like they had been in the past.
So based on that, Kim, before we let you go, we were talking cyclicals a little bit earlier, and I'm curious about the mid and the smalls and where they sit for you right now.
I think they're super interesting because, again, they've been overlooked where everybody's been giving all the love to the Magnificent Seven. And I think there are companies out there that are well positioned for growth that are smaller than the Magnificent Seven. I know some of you don't believe me, but check it out. And maybe this earnings season, we're going to see some growth happen that surprises investors and attracts people into those names. And that's pretty much why I love earnings season is you get to find out winners and losers, and there are always some surprise winners.
All right. Well, I'm glad you love it, Kim. And we believe you. Trust me. We even have a little poster behind us. Kimberly Forrest, founder and chief investment officer over at Bokeh Capital Partners. Always a wonderful conversation with just about a minute or so until we get to those closing bells. Do you believe, Alex Steele?
In what?
In the Easter Bunny. What do you think we're talking about? Were you listening at all in that interview?
Well, yeah, we were ended on earnings. I believe in earnings.
You've been running around to all these climate conferences in heels, by the way, which you saw. How many steps have you put on?
7,300 steps in heels.
Okay,
like
so you're a little
heels.
exhausted,
so
right?
my feet really hurt.
Okay.
No, but really, what do I believe in? Earnings?
In Kim.
Oh, I believe in Kim.
Okay,
I
thank
believe
you.
in Kim for years. I love Kim. She knows that. We have a shopping date at some point.
We have some breaking news here. This involving Caroline Ellison. Of course, she was the CEO over at Alameda Research, tied to Sam Bankman-Fried. She has now been sentenced in her FTX case, and she has been sentenced to 2 years in prison. Remember, Sam Bankman-Fried got 25 years in prison. Ellison testified against SBF here. Maybe that contributed here to the lighter sentence. She was at one point facing close to 100 years in prison. The main headline crossing the Bloomberg terminal is 2 years in jail in that FTX case. We're going to wait for the other headlines to cross as well to see if there's anything additional that we should be paying attention to here.
All right, taking a look at the market here, going nowhere fast. I got to tell you, Romain, volume super light on a day like today.
Yeah, kind of an interesting, strange time here as we get into that nether region here. The Fed is done. Earnings season hasn't yet started, and the market left to its own devices, but that's good enough for green across the screen here on this Tuesday afternoon. The Dow Jones Industrial Average pushing higher by more than 80 points here on the day, or about 0.2%. The S&P 500, 5733, and yeah, another record high there, up about 14 points or 0.3%. The NASDAQ Composite higher by about 0.6% on the day. We should point out, though, the Russell getting in on the action as well, up about 0.2%. And I just want to point out real quickly, our outperformer on the day in a pretty big way here, Alex Steele, that actually belongs to the Dow Transports. Dow Transports up 266 points, or about 1.6%. 19 of the 20 members higher on the day, led largely by a 4% gain in Uber and a 3% gain in FedEx.
This also leads me to the IMAP. If you go there, it's a little bit of a hodgepodge of red and green, but the green part is materials and then tech. Two different stories, right? One was NVIDIA and the other is due to stimulus from China, but some of those cyclical names doing well too. Plus, you got consumer discretionary, industrials, and materials, one of the top three performing sectors in the S&P.
All right, let's take a look at some of the individual movers out there. Joining us right now, the best of Bloomberg joins us at the table, Amy Orr and Isabel Lee. And Amy, I know you've been keeping an eye on some of the big movers. Who you got?
Yeah, Visa is actually down 5% so far. So remember in the afternoon, the Justice Department has decided to sue Visa over antitrust issues, mainly about how it monopolized the debit card payment market. I think it started when it tried to actually acquire Plaid, and then it was really about how it was like asking some of its members to actually pay less if they use their service.
Yeah. Should I be excited about this? I mean, now that the DOJ has gotten involved, are my fees coming down or something like that?
Well, not immediately.
Alex isn't a believer, so.
Well, pay your credit card payment first so that you don't have to pay for the fees. The next one is Costco. So Costco is actually like in the public arena that a lot of people are actually upset that they're actually scanning their IDs and also changing the packaging of its
I'm upset.
rotisserie
I've never
chicken.
had a membership. I just piggyback off everyone else's membership.
And
my mother's.
Right, that's exactly why they're doing it.
Well, I don't screw them. I don't like that. Anyway, that's why the shares are down.
Yeah, it's down, but it's not that much. It's around like 2% or so. But people are really upset. And also, like, remember that Costco has actually gone really far up, like in the run up to the interest rate cut. So analysts are saying that the upside is actually quite limited.
Yeah, and you know, Scarlett Fu is like, isn't she like a titanium member of Costco or something?
Yeah.
I've been trying to get her to loan me her card, but she says no.
She says no way.
No way.
She gets this really big oil of Olay lotion for her face. It gets me very upset. All right, and the worst performing stock in the S&P, or one of them is Regeneron.
Yes.
Why?
Well, because one of those, the competitor, Amgen, can actually launch a copycat version of its eye drug. It's called Eylea. So essentially, this means that it can actually be up for competition. And also the fact that it actually might have a price kind of pressure as well. But analysts are actually saying that even though some of them downgraded it, some of them are kind of like pulling back on the target price, there still could be a 20% upside according to RBC.
You know, I just realized I started this the wrong way. I started with the decliners, but I was supposed to start with the gainers. So Isabel, you got to jump in here and stop me. I mean, Alex knows this, but you don't yet.
But you can end on a positive note, so we can do that.
I was so worried. I was trying to think of what Kim Forrest was saying that I was supposed to remember. So go ahead.
I'm looking at Liberty Broadband. So shares are up around 25%, and this came after the company, which is owned by John Malone, who is a cable tycoon, also known as Cable Cowboy, proposed an all-stock merger with Charter Communications. So a merger would consolidate two public companies, and Malone has been looking for years to simplify his empire by really eliminating the multiple stock classes that has been the hallmark of his style. So prior to Monday's announcement of this, we actually have Liberty down almost 70%. So you see investors really reacting to this good news. And it also opened with a pop, and it sustained that gain, which is the important thing.
Yeah, I was looking to see. I wonder how much short interest also was on the stock.
Yeah,
that's true.
Absolutely.
All right, what else you got?
Next, I'm looking at Snap. Snap said that it would be using the generative AI model of Google, and that's to power its AI chatbot. So Snap has been investing really heavily on this to compete with its larger rivals like Meta, who has its own Snapbot. So Google, meanwhile, has been looking for clients for Gemini. So it's kind of like a match made in heaven. And as we know, it's really a competitive space in this AI landscape. A lot of companies are really looking to launch the chatbot. I mean, now if you use Google, I was surprised. I think it was last month that I first noticed that when you type, what is the meaning of XYZ, an AI thing pops up.
Yeah,
and
I hate that, by the way. But yeah,
some
thank
people
you.
love it. And a lot of my friends actually don't go to ChatGPT anymore because then you use that.
There you go. All right, well, that could be a win for them. What else? You're also taking a look at Ryan?
Ryan Specialty. So we have shares up after BMO raised the recommendation and increased their price target from 75 to 75 from 65 and to outperform from market perform. And they cite numerous reasons like acquisitions, healthy double-digit organic growth, and just really a lot of ongoing investments which should provide a fog-free runway, they said.
Fog-free runway.
I think we like that, right?
I love the euphemism.
Because you don't want to take off with fog.
Yeah, no,
and a flight
into that.
Sure, why not?
Yeah, guys, I'm looking at the bond market, and you can all kind of argue that on a headline level is the bond market, particularly the front end, that did a lot of the work today. You're looking at 2-year yields ending down by about 5 basis points. The takedown for the 2-year was totally fine. That came out there. You're seeing a steeper yield curve, but because of that decline in the front end 2-year yield, we also get more auctions and more supply coming on the next 2 days. But that hasn't seen to be a problem recently.
Yeah, it'll be interesting to see kind of what happens too as we get a little bit more removed from that last Fed meeting and more into sort of the earnings season, also the economic data, whether that changes the yield picture at all. It was kind of interesting. We were going around the table, guys, earlier talking about some of the stories that we were interested in. And there was an interesting story that was out earlier today about Coca-Cola. I don't know if you've seen these ads for spiced Coca-Cola. Are you familiar with this?
I'm not familiar, but I would be very interested. The only kind of feedback that I heard is not spicy enough.
Well, okay, well, you're too late because they're actually just discontinued it.
Oh, no.
So apparently no one knew what the heck this was. I thought it was actually spiced as in like spices were being put in here, but I was told that's not true. It's apparently just a euphemism for it's like a more punchier version of Coca-Cola. Apparently no one knew what this thing was and no one bought it.
Yes.
6 months and they've discontinued it.
It's interesting and surprising because they launch it as a permanent flavor because Coke is known to launch, a series of seasonal flavors. And I went to Reddit, which is the best source of news, and a lot of people said, it's really just like Coke Zero with a hint of raspberry. So
raspberry and spice flavors.
Yes,
isn't that Dr. Pepper?
Exactly, and it doesn't match the spice label. But then Coke is known for its unusual styles. Remember the Oreo flavored soda? So
I don't
know. Oreo flavored soda.
Did you have that? Amy?
No.
No? Okay.
I should really be tapped in more to the market.
You need to run out to the store right now and get yourself a spice before it's pulled from the shelves.
I'm looking at more like the Monsters, like the Celsius, and also the Liquid Death. Well, Liquid Death is probably planning for IPO, so that's what I'm going, which is just a sparkling water.
And keep the can, because that's a great
I know, I bought Liquid Death thinking I was something like
cool,
important, and it was just like
it's not at all.
Apparently
it looks cool.
The theme for it is when you go to like music event or whatever, and then you don't want to be holding just a sparkling water. It doesn't look cool. But if you hold a Liquid Death.
You're totally jamming.
Yeah.
I also wonder too if this is because of Poppy. It's like the soda that's not soda, and it has like better stuff. They bill it as better stuff for
it's
you.
supposed to be like probiotic or something.
Exactly, and like no added sugar and stuff like that. So like that stuff kind of eating away into the traditional sort of more interesting Oreo Coke or like raspberry flavored spice Coke.
I mean, if I'm going to drink pop, I mean, just give me the full sugar.
Pop, that's Midwest.
Yes, I'm a Midwesterner. I don't know all you East Coast elites with your fancy soda words there. Our thanks there to Amy Orr and Isabel Lee helping us break down all the big market moves here on this Tuesday afternoon. Alex, I hear you're out back to Climate Week somewhere out in the wild blue yonder, but I'm going to stick around.
You're staying, man. You're
staying.
I
got to stay around, do my penance here for another hour, but we got some good guests coming up, including Bruce Van Saun. He's the chairman and CEO over at Citizens Financial Group. We're going to talk to him about the state of the banking industry. That's coming up next, right here on The Close on Bloomberg. Welcome back to The Close. I'm Romaine Bostick here at the close of business for cash markets. The S&P 500 hitting yet another record high. Modest gains on the day, to be sure, just about 0.3%. Nevertheless, that keeps the market elevated at 57.32 and change, with a lot of strategists now upping their price targets for year-end to as much as 6,000. You did see a little bit of weakness in the mid-cap space, weakness in the dollar, though the commodity space got a really big boost here on the day. That's largely because of the news that we got out of China overnight. Monetary policy stimulus coming in a big wave. Several measures taken, several measures that had long been anticipated, long been hoped for by investors, and they got it. That saw the Chinese market rally about 4% here on the day, and you saw that reflected in some of the ADRs that trade here in the U.S. That included names like JD.com as well as Alibaba Group. Alibaba posting about an 8% gain, their ADRs here in the U.S. Some of the other big stories as well involving M&A, including Liberty Broadband and John Malone really trying to take this company to a different level in the combination it's trying to do with Charter right now. A 28% pop in the shares. Smartsheet also getting a bid, up about 6% here on the back of the news. The Blackstone and a few others are ready to take this company private. And keep an eye on Visa. Those shares down about 5.5%. A Department of Justice investigation here in the United States, I should say a lawsuit here in the United States, as Merrick Garland, the Attorney General, alleging that the company has violated at least two portions of the Sherman Antitrust Act. Of course, this is something that could take years to play out. Nevertheless, investors, the knee-jerk reaction, pushing the shares lower here on the day. That's what happened in the cash session. Meanwhile, in the after-hour trade, we are seeing shares of KB Home move lower, down about 5% after the company just reported earnings. Deliveries in its most recent quarter coming in slightly above estimates at about 3,600. The street was looking for around 3,500, but maybe some softness when it comes to EPS, $2.04 a share. The street on average was looking for $2.06, and the company provided a full year revenue forecast, a range of $6.85 billion to $6.95 billion. Previously, it had a range of 6.7 to 6.9. So it looks like a slight miss on the earnings front, but some of the other metrics here are either in line with estimates or slightly above. All right, we do want to pivot from that and talk about the world of banking, specifically regional banking. Today marks the 10th anniversary of the IPO of Citizens Financial, ranking it as the largest in U.S. commercial banking history. Bruce Van Saun, he's Citizens Financial Group Chairman and Chief Executive Officer. I'm pleased to say he joins us right now down in Lower Manhattan at the New York Stock Exchange, where he had a chance to ring the bell. All right. It's been 10 years, Bruce. First of all, congratulations. I mean, just making it this far, particularly given all that's gone on since that IPO debut back in 2014. Give us a sense here of how much the bank has changed, and I guess to a certain extent, maybe you as a CEO have changed over these years.
Yeah, so thank you for the congratulations. It's been an incredible journey for us, and there was a lot of work to do because we had a parent company, RBS, that was in some trouble, and so we had to make up for a lack of investment and really focus on building out the foundation blocks and then finding the areas that we could successfully grow in. But I think at this point we've had a real transformation of our consumer bank. We have really invested heavily in the commercial bank, and I think we have one of the best positioned regional commercial banks. And now we've made a big play to get into private banking and private wealth after the failure of First Republic last year. So we built out some really strong businesses. We're not the finished article. We've made a lot of progress, but we feel really good about our outlook for the future.
Let's unpack some of those segments. And I do want to start with the wealth management business. This is relatively new, at least in terms of the expansion that you've had there. I guess the question is, why did you choose to go down this road? And are you finding, stiffer competition than you expected?
Well, I think in any business, you really win with great talent. So the opportunity to take some of the best private bankers in the country who really didn't fit the JP Morgan approach to the business and wanted to recreate what they had at First Republic in a 2.0 strengthened platform was very appealing for them to come to us, and for us in trying to really make inroads into that business. We lock up the talent and then we bring our overall capabilities across the consumer bank and the commercial bank to their customer base. We thought that was the perfect way to get a foothold in the business and then really ramp it. So far, we've had a lot of success. At mid-year, we already had $4 billion in deposits. We have $3.6 billion of wealth assets under management, and we have a lot of momentum. So really excited by that. And we're also bringing some wealth teams in because they see what we're building and they find the platform at Citizens to be highly attractive.
What's the cost of those acquisitions, Bruce, in terms of bringing these people on board?
Yeah, last year it was interesting. So with all the turmoil that was taking place, we nonetheless said, let's go on offense here. We've got a strong capital position. We invested 11 cents of EPS because when the people come in, the expenses come first and then the customers come later and bring the revenues in. We did say that by the fourth quarter this year, the lines will cross. We have enough business now in the door that will go from losing that 11 cents to breaking even by the fourth quarter. And then by next year, we said the line will keep going up on the revenue side and will hopefully be 5% accretive to our bottom line. So we're on track to deliver all of that.
Of course, part of this was, at least this latest push was born out of that quote unquote regional banking crisis that we had back in early 2023. How much, I know that Citizens itself wasn't quite as affected by this as some of the other banks, but when you look at sort of the fallout from that, have you seen deposits and more importantly, just depositor activity get back to some of those pre-crisis levels?
Yeah, so I think for a while, all regional banks were on the back foot, like there was a who's next kind of sentiment in the marketplace among depositors. But we always had strong capital and liquidity position, so you had to tell your story. But over the course of last year, things started to settle down, and they're pretty stable this year, which really allows you just to get back to business and focusing on delivering for your customers and executing your business strategies.
I do want to talk about the state of the real estate market, particularly commercial real estate. I know Citizens has some exposure there. There's been a lot of talk about whether that industry was on the precipice of collapse. There's been a lot of stories on Bloomberg just in the past few days that those sort of death notices were greatly exaggerated. For you and your portfolio, what is the state of commercial real estate?
Well, I would say broadly, most of our portfolio's in pretty good shape. So multifamily and industrial and distribution space where we have exposure in those segments, those are making it through reasonably well. The big concern has been general office, and where, I think the pandemic certainly changed work behavior. So there's more people working remotely, and the market has to make adjustments. So you kind of add the higher interest rates, higher inflation on operating costs, and then less demand for space long term. There's a major workout that has to take place. And I think, the nice view from our standpoint is that we have this heavily reserved. We have our best people working on solutions for borrowers. We're charging off loans and working off loans. It's probably going to be with us through a good chunk of next year, but it's not something that really impacts the overall performance of the bank. It's kind of ring-fenced, and we're working through it.
Does the drop in interest rates, or at least the start of the drop in interest rates, does that help? Is that going to help?
Yeah, that should help, particularly I think when the Fed gets on with it and the rates get down maybe 1.5% to 2%. I think that'll really start to benefit many borrowers.
Bruce, I do want to talk about just your tenure here. Of course, you were at the helm when this company went public here in the U.S. Back in 2014. You've had a long career. I'd be remiss in not asking you what your plans are for the future, how long you expect to stick around in that seat as chairman and CEO.
Yeah. So I'm still really engaged in what we're doing and building a top-performing bank. I've got a great team. I still have plenty of gas left in the tank, so to speak. So I have no imminent plans to step aside. But we are working on kind of building a bench and making sure we have succession inside the company. And I think I've got some good folks that are developing that could eventually run the bank. So anyway, there's more to do. I'm happy doing it. I have a spring in my step every morning when I get out of bed. So we're doing it together as a team.
Has there been any discussions about M&A, Bruce?
Well, I think there's always an opportunity to consider, can you find ways to accelerate the build out of the bank? At this point, the last major piece that we needed to get done was New York Metro, and we did the acquisitions back in 2022 of HSBC's East Coast branches and Investors Bank, which give us 200 branches in New York Metro, 1 million new customers. We're being very successful with that. That was kind of the last big to do. So I think at this point, we'll focus on organic growth, and we'll be opportunistic. If there's things that look attractive to us, I think we're strong and we have an ability to integrate things successfully, but we don't have to do those things. I think we have enough scale to continue operate successfully and drive the results we're looking for.
Hey, Bruce, appreciate you taking time for us. And once again, congratulations. Bruce Van Saun there. He's the chairman and CEO at Citizens Financial Group down at the New York Stock Exchange here on the 10th anniversary of that company going public here in the U.S. Of course, that used to be a subsidiary of Royal Bank of Scotland Group. When we come back, we're going to talk about big tech and we're going to talk about Meta. Meta kicking off its annual Connect conference tomorrow. We're going to break down what investors need to know. That's coming up next here on The Close on Bloomberg. All right, Meta is kicking off its annual Connect conference tomorrow as investors turn their attention to Mark Zuckerberg and any AI updates. Mandeep Singh of Bloomberg Intelligence. He's joining us right now to talk a little bit more about this. And I feel like in years past, this Connect event really didn't do a whole lot. And then, of course, they had the big metaverse headset thing. This one tomorrow, there's a lot of anticipation around this one. Why?
Absolutely. And look, they've done a number of things that have played out very well. I mean, notably the whole Llama large language model, the open sourcing of it was a very smart move because that has helped, develop an ecosystem. And right now, everyone is focused on generative AI. They have a model that's performant with OpenAI, the leader, and Anthropic. So clearly, a lot of traction. And they've actually deployed it across their family of apps. I mean, people talk about the ROI on Gen AI. Meta is the live example because all their ranking and recommendations are being driven by Llama model.
So what's the demonstration tomorrow on that front? I mean, what do they want the world to see?
I mean, I assume, will show you a feed on Instagram where Meta chatbot is there. You could ask a question and it can, respond. It could be anything that's going on in your life where a chatbot can add value in terms of a group discussion or something like that. Same thing with messaging. WhatsApp monetization was a concern for the longest time. They've actually rolled out chatbots within WhatsApp, and I expect that to be a theme tomorrow as well.
I'm also curious about this new hardware they have, these glasses they have, and Meta has always had a somewhat spotty track record when it comes to hardware. I see a lot more people with these Ray-Ban style or their Ray-Ban glasses on now. Explain how that fits into this whole AI strategy.
I mean, the best way to think about, AR glasses is it's got AI built into it. People are talking about, Apple Intelligence and why iPhone 16 Pro is not a good upgrade because you don't have Apple Intelligence right now. Meta AI glasses actually have an AI assistant. You can talk to that assistant, and it can actually do a lot of things. I mean, it's limited by, the iPhone is tethered to, but at the end of the day, you can do a lot of things. That
kind of hurts because I just ordered a new iPhone 16 Pro. So you're telling me that basically I should have put my money into the Ray-Ban Meta glasses?
As of now, I think Meta AR glasses is a better purchase for playing with AI than your iPhone 16.
I am curious as to why we haven't seen, at least the perception is that Meta hasn't articulated its AI strategy in the same way that maybe we've heard from Microsoft, or even Apple. I know Apple was criticized for that as well, but at least they finally came out and said what they had to say here. Why do you think the perception has been they've been more quiet about it?
I mean, look, people always have a tough time, trusting Meta with their data. They had so many issues over the years around data. And we know these large language models are built around, constant training, more data. So for them to really have that widespread adoption at the enterprise level, companies have to trust. This is an open source model we can trust for the long term, 10, 20 years out. And right now, I think it'll take them a while to build that trust, but they are making a lot of progress.
All right, Mandeep Singh, analyst over at Bloomberg Intelligence, a closer look at Meta and its big Connect event tomorrow. Expected, of course, talk about those glasses as well as its Llama AI model. A lot more coming up here on the big program, so stick with us. Our top three, where we focus on the top three movers and shakers at the center of the day's biggest stories. We're going to have that rundown coming up after the break, right here on The Close on Bloomberg. All right, it's time now for the top three. This is where we name drop the people driving some of the day's most talked about stories. And we're going to start off today with a closer look at Starbucks and, well, a new head of its China business. Molly Liu has been named by Brian Niccol as the sole leader of Starbucks' China business. This is a part of a plan to shift leadership to a, quote, new generation of successors. Now, Liu's appointment marks the second executive management change at Starbucks in roughly 3 weeks since Niccol took over. And of course, China could potentially be a key market for the company, a market that Starbucks has struggled with over the last few years. Another person that I'm keeping an eye on is Caroline Ellison, the former top executive over at Sam Bankman-Fried's fallen FTX empire. She was CEO over at Alameda Research. This is the cryptocurrency empire. She testified against her former boss and, of course, former boyfriend as well. He got 25 years in prison. She just got sentenced today to 2 years in jail, a much lighter sentence than what Sam Bankman-Fried got, a much lighter sentence even than what Ryan Salam got as well with his 7 years in prison. And finally, I'm keeping an eye on Prince William. Yeah, Prince William. He's announcing the finalists for the $1.3 million Earthshot Prize. The lucky contenders include a Kenyan company combating food waste through refrigerated boxes and a British startup that samples environmental DNA to measure biodiversity. Now, the 5 winners will actually be selected in November. Remember, this Earthshot Prize started back in 2020 as a way to fund companies that were directly trying to create products and services to combat the effects of climate change. All right, we do want to take a quick look here at how markets closed here on the day. It was green across the screen, though we should point out volume was relatively light and the gains on the day were relatively modest. But for some folks, that's good enough. 0.5% gain on the NASDAQ 100. We should point out the S&P 500 did hit another record high on the day, only up about 0.3%. But the outperformer on the day, you're going to find that in 2 spots. Dow Transports up 1.7% here on the day, lapping every other U.S. indice out there. This is led largely by some gains in FedEx, gains in Uber, and a few others. And of course, what we saw in China. This was a huge deal. The NASDAQ Golden Dragon Index up 9% on the day. The CSI 300 up about 4%. This after China announced a series of monetary stimulus measures, long-awaited monetary stimulus measures. Now, we should point out that investors originally were sort of reticent about some of these moves, but by day's end, they really did begin to embrace it. That had a ripple effect on risk appetite across the globe. You saw the CAC over in Europe rally hard, more than 1% here on the day. In the U.S., you saw the gains, and you also saw that reflected in the riskiest of assets, including crypto, Bitcoin getting a 1.5% bid on the day, right around 64,000 and change. It's UN General Assembly week here in New York. It's also the week of the Bloomberg Global Business Forum. Alphabet CIO Ruth Porat now on stage speaking with our very own Eric Schatzker. Let's take a listen.
500 million people on the planet can now access information in their own language. That's the second part of the triangle. The third part of the triangle is ensuring that people have the skills to thrive in this changing world and ensuring that we're doing the right kind of training, skilling globally. Delivering on that triangle maximizes the upside and helps with some of those issues that you asked about on the downside.
President Biden will be here on this stage in a few short minutes. Please don't think of us as the warm-up act. His administration has developed a wide range of initiatives around AI. What do you hope to see in terms of AI policies from the next president, whomever that happens to be, and the next Congress?
Well, I think very importantly, let's take stock of what has been done, because I think at the core of the approach from the White House, from the president and his team, has been a recognition about the strategic imperative due to the economic upside and the social benefit upside. And so the private sector and the public sector to work together has been key, point number one. Point number two, they've taken a risk-based approach, which is a recognition that AI is applied to many different things in our daily life. The opportunity is wide, and so there's not one size fits all. Think about the risk inherent in the application of AI in any area. And then they've required the industry to do a number of things to actually mitigate against the downside around transparency, around red teaming, things to prevent abuse of it. The other thing is really encouraging bipartisan solutions. So I would also say, if I could broaden it out, right now in the Senate, there's a bipartisan approach around an AI framework that Senator Schumer and Round and others have proposed. And again, it looks at all elements of how do we invest to be competitive, how do we prevent working on the downside. So I would hope it's a continuation of this and that it continues to be bipartisan, because it's such a critical issue.
I'm going to make an assertion. If the West is going to win the contest in artificial intelligence against a centrally planned economy, that would be China, of course, the public and private sectors, to your point, have to work together collaboratively as partners. How would you rate the effectiveness of that partnership today?
Early days, and I think very strong. And let me explain why. I think you're absolutely right that this is a strategic imperative. The good news is the U.S. today, the West today, is in a leadership position, but that is not a foregone conclusion. We have very formidable competitors globally. And so I would say there are a number of different levels on which it's operating. The government, the U.S. government, the White House, has really pushed forward things like the Partnership for Global Infrastructure to make sure not only that we're investing in the U.S., but that we're working with countries around the globe in a way where we can bring infrastructure solutions. We just announced, as an example, Google did a cable from Kenya down to South Africa over to Australia that helps build the resilience that's needed. And to my prior point about the triangle, you've got the infrastructure that unlocks the content that's needed to access world markets. So areas like Partnership for Global Infrastructure, really important, public-private partnership, really important. But there's another critical element that's true for everyone in the room, and we're seeing it again at the federal and state level in the states. It's important to lead from the front. I talked about this $17 to $25 trillion economic upside opportunity. That only happens if we see what economists call diffusion. It is being used in every industry, and we're already seeing a lot of effort around that.
There is an important question around the sustainability of AI, and it has to do with energy. I know you know the numbers. A ChatGPT query uses 10 times as much electricity as a Google search. I'm assuming, of course, that a Gemini query uses less. Globally, energy demand, is going to increase by some 2.5-fold in the next 5 years, and with it, of course, a similar jump in carbon emissions from data centers. Can we really have an AI-powered future while getting to net zero by 2050?
It is absolutely imperative that we continue to focus on it. At Google years ago, we made a commitment about running our data centers 24/7 on carbon-free energy, and there are a number of components to that. We're continuing to invest in renewable solutions around the globe, but I also want to say that one of the very important parts, we, like others, are investing substantially to improve the efficiency of compute, and you're seeing it in two places. You're seeing it in the chip side, hardware, and you're seeing it in models. Model efficiency has increased with some of the testing we're doing anywhere from 100 to 1,000 times. It's the right thing for the planet, and if you just put it in economic terms, for us to get a return on invested capital, two things need to happen. We need to, one, make sure that we're seeing this diffusion throughout the economy, that there's actually growth that is delivered from the investment in AI, that it's not something that's kind of sand between your fingers.
And you're listening right now to Alphabet CIO Ruth Porat speaking live with Bloomberg's Eric Schatzker. This is over at the Bloomberg Global Business Forum taking place here in New York. We have to break away from that, but you can continue listening to that conversation by typing Live Go on your Bloomberg terminal. All right, of course, Ruth Porat is in town, like a lot of folks, for the United Nations General Assembly. But there are some real stars in town right now. And no, it's not world leaders. They are, of course, the people that we gravitate to most. Olympians. Masai Russell from Team USA and Zoe Hobbs of Team New Zealand are joining me now. They are two of the world-class athletes participating in Athlos NYC. It's a first-of-its-kind track event, bringing the fastest women in the world together to compete over at Icon Stadium on Randall's Island, and it's being funded by 776. That's a venture capital firm founded by Reddit co-founder Alexis Ohanian. Welcome to the big program here. Great to have you here. I feel like I'm in the presence of greatness here. And now I'm told in just 2 days, I believe Thursday here in New York, you guys are going to have to do this all over again. It's not the Olympics, it's not the World Championships, but this is a big event. I mean, they've assembled some of the greatest women track and field athletes, and you all are going to kind of just hash it out there on Icon Stadium. What's that going to be like?
I just feel like it's going to be amazing. It's going to be great. The energy is going to be electric. You know, like Kayla said, it's going to be a mixture of like Coachella meets the track. And that's what I'm just excited to feel, to be a part of, the first annual experience. And I'm just excited.
We'll talk about kind of what this means, because when we talk about track and field, a lot of people only pay attention to track and field basically every 4 years. You have some diehards that might watch the championships in between. But this seems like it's an effort to sort of make this more of a year-round type of spectator sport.
Definitely, yeah. And like you touched on, people always tune in the Olympics, and that's the biggest year that we always have, but it's the same thing every year that we can showcase our sport to be so special as it is. So I think this event's going to be amazing for us to showcase women and give us a platform and opportunity to show what we're about and what we do. What's going to be the difference between doing a meet like this and doing the biggest of all stages, the Olympics, Masai?
Well, I feel like this meet is just more I don't want to say the Olympics isn't fun, but it's definitely more serious, and it only comes around every 4 years, whereas a meet like this, hopefully it does become an annual thing, but you know, we have performers coming, celebrities coming, people are just more interested, and it's all women. We're putting women on the map. You know, this is all about women empowerment, women in sports, just really driving that, because track is on the brink of doing something amazing, especially in the women's space. So I feel like us getting this platform at this meet with just women, and it being the highest prize money ever from an all-women's track event is going to be great.
Well, expand on that, Zoe, because, I mean, women athletes overall have been having a moment. We talk about the WNBA. You have some WNBA teams that are outselling tickets versus their NBA counterparts. You have other sports, including tennis, golf, where we've seen just the presence of women athletes, but more importantly, the interest in them, and not just amongst girls and women, but also among men and boys as well.
Yeah, so I think this is going to be an awesome opportunity. We have a long way to go in track and field, and we have the world's best athletes and the world's fastest athletes, and that's so exciting to get behind. I think Athlos is going to do an amazing job of creating some creativity around track and field to bring the excitement and bring the hype like other sports do. So, yeah, I'm really looking forward to Athlos in 2000.
Now explain how this works. So, I mean, you're a sprinter, you're a world-class hurdler here. Now, you two aren't going against each other, right? Because that wouldn't be fair, right? No. Like, she would be like, so basically, let me do the hurdles, and she'd be like, let me just race you in, you know, what is it, 50, 100 meters or whatever. So you're not competing against each other, that's right.
No.
But you're each going to do your respective disciplines, is that right, Zoe?
Yeah, that's correct. Yeah. So we've got the 100, 200, 400, 800 and 1500 meter events. So we've got 6 competitors in each of those, and we'll all line up against our 6-lane events.
How do they choose the athletes that were going to be a part of this? Was it just, we're just going to go for the best in the world and hope they say yes?
I think that was the, you know, the driving factor behind it. I know for the women's hurdles specifically, I mean, there's a world champion, two-time Olympic champion me, Olympic champion Jasmine Camacho, world record holder. I guess they just wanted the best field across all 6 events with 6 women in each event. And, you know, it's just, like I said, it's pushing women in sports, and we're just trying to showcase the best athletes in the world at a fun track meet and being able to show it at the best in the highest stage.
And obviously the prize money helps to lure some of those athletes
Absolutely.
there. Talk a little bit about that, because a lot of people don't really understand how Olympians sort of make a living. Obviously you get some prize money here and there. Obviously endorsements and sponsorships are, I would think, are a much bigger component of your income.
the biggest component for us is the sponsorship from the big shoe brands like a Nike, Puma, Adidas, New Balance, things like that. So I'm sponsored by Nike, and that's where most of my base contract money comes from. But then you do go on to the circuit and compete at the Diamond League events or these Continental Gold events, and you know the prize money is it's good, but this meet being just I don't want to say a regular meet, but outside of a championship, this is the highest paying meet that you'll find in America across the board. So we're not traveling to Tokyo or traveling to China to make $10,000 because that's what the prize money is for the Diamond Leagues. This is a $60,000 win. The second place is $25,000, and the third place is $10,000. So I can, travel up the street and make 5 times as much as I would going 14 hours across the world. So like I said, it's just, it's pretty great.
Well, I don't know, for the New Zealander here, I mean, you had a pretty long flight, right?
17 hours home direct.
I know.
But that's kind of part of being an athlete in this sport, right? You're always kind of traveling to go to these various meets, and some further than others, right? Zoe, do you expect that these types of meets with these higher purses are going to become more common?
I hope so, and we need it in our sport. $60,000 is far way off from $10,000, as Masai has just mentioned. This is an amazing opportunity for women to be part of, and I'm excited to get the opportunity as well.
Has there ever been any discussion with these meets about in terms of media partnerships and sort of making this more visible for those folks who maybe can't make it physically to this thing, that maybe we'll start to see more of this stuff on, if not a major network, a major sports channel?
It's definitely been a big part of this meet as well, is getting as much exposure outside of those who can actually physically attend, getting it on TVs across the world. So making it as accessible as possible has been definitely an important point to touch on.
Now, are you going to have any fun while you're in New York, or are you just training and sleeping?
No, I'm going to have fun. The off season starts Thursday at 7:36. Because I run at 7:35. Off season starts at 7:36.
And the good thing about it is that the UN will pretty much be over. So all the traffic, you'll be able to get around the city and go have some fun. Well, this is great. I'm really looking forward to it. This is a great venture with Athlos, and of course Alexis Ohanian, what he's done there, and obviously is Serena going to be there? You didn't tell me.
I hope.
Okay, I hope so too.
I mean, I don't know if she's going to be at the glam shoot, but I know that it's her product, it's Win Beauty.
She's got a poke.
So I hope that she shows her head. I missed her at the U.S. Open. I was overseas, so I'm hoping I get to meet her.
Okay, well, hopefully she'll be there, and we'll all be keeping an eye on both of you. And congratulations to both of you.
Thank you.
Already a great career, and hopefully even better off of the back of this event there.
Thank you.
Masai Russell from Team USA, Zoe Hobbs all the way from Team New Zealand. Thanks to both of them there, and be sure to check out the big Athos event that's coming up this Thursday, September 26th. All right, stick with us. A lot more coming up here on the big program. We're going to set you up for some of the potential market-moving events over the next 24 hours. This is The Close on Bloomberg. All right, let's talk real estate, commercial real estate. Wall Street is driving an office revival on one of New York's fanciest addresses, Park Avenue. Bloomberg's Norah Melinda joining us right now for more on this story. And you framed this story around kind of the rebound that we've been seeing in SL Green, which, of course, is one of the biggest real estate owners, I guess, if you will, REITs here that's focused on Midtown Manhattan. Why is there a revival going on
there?
It
calls itself New York's biggest landlord when we're thinking about office. And
I'm not sure that's true, but
But I mean, that's what they say, right? But it's seen a pretty strong rally. It's actually the best performing office REIT here year to date. And that's because of its focus primarily on Midtown and the Park Avenue and Grand Central Terminal area. I mean, of course, it had One Vanderbilt, which is a really successful property that opened back in 2020. And so that's really been in focus. And especially as we're seeing a revival of Wall Street, the Wall Street bros, they're actually coming back to Grand Central Terminal area. And just reluctantly as these offices push them back in. And so we're seeing a lot of companies really trying to position themselves in those areas to really get people to feel a bit more convenient with those commutes.
So talk to me about vacancy rates along this Park Avenue corridor, which is, we're not far from it here at Bloomberg World Headquarters. I would assume that vacancy rate is probably a lot lower than what it is in other
Most
parts
definitely.
of the city.
I mean, we're really seeing a bit of a pullback, but we are seeing Park Avenue as the area in Manhattan that is seeing the lowest vacancy rate. We're seeing less than 10% vacancies around Park Avenue.
Now, wow. Okay.
That's a massive change from what we saw years ago when we were seeing BlackRock and everybody else exiting the area. But now we're seeing an influx, and really people are competing to get not only the best properties. I was looking at the analyst that wrote up this note that inspired the story, and he said, Wall Street bros, they're looking for Vest and Class A properties.
And I've noticed, and obviously, Park Avenue, for a lot of folks, it's a prestigious address, whether you're actually on Park Avenue or not. That's a whole other conversation. But it gets to this idea, though, too. You walk down there, and you got several new buildings being built. Obviously, the JP Morgan headquarters is probably the most notable one. There's a couple other holes in the ground there. And I'm just curious as to, when we talk about Evercore and these other companies, are they building new buildings, or are they just taking existing buildings and transforming them?
It's a combination of both, because you are seeing a high demand for new buildings, but you're also seeing older buildings, and people just want to see that the landlord is pouring money into these buildings to make them up to par. People want to be in a place, if they're going to leave their homes, they want to be in a place that's comfortable and snazzy. That's what they're looking for.
Is this going to spread, though, beyond just, at some point you're going to reach critical mass, prices will be so high, and any sort of would-be lessees are going to have to find another place to go?
Right. I think that's really the question as to what this looks like moving forward and what will be that critical point. Will this permeate into the future? I think that the analysts that I spoke to and many others will say yes. And he's one of 3 analysts that are a buy on SL Green. And he's really been pushing this management team when he feels as though the majority of Wall Street has not been looking at them.
All right. This is an interesting story, too, and it gets to this idea, though, too, of we've always talked about how commercial real estate has been in trouble, not necessarily, though, if you're a Class A building and not necessarily if you're in a prime address. And this story really seems to encapsulate all of that all rolled into one. Bloomberg reporter, Norah Melinda here. A great story on the Bloomberg terminal. Wall Street drives office revival on Manhattan's ritziest street. And it's not Lexington Avenue. All right, let's push ahead here to some of the big potential market-moving events that we're keeping an eye on over the next 24 hours. And we start off in the morning. Tomorrow morning, we're going to get the interim economic outlook report out of the OECD. Now, this doesn't always move markets, but it does give a bit of a long-term outlook here for where investors, and for that matter, economists, really see the global economy going. A lot of challenges out there. And then at 1 p.m. Eastern Time, the Meta Connect conference, a conference that normally a lot of people ignore, but Mandeep Singh said this one is going to be big. Meta putting its llama cards on the table. That generative AI strategy is going to be front and center. We also get some economic data tomorrow as well in the morning. NBA mortgage applications at 7 a.m. That's followed by new home sales at 10 a.m. Eastern Time. We'll have full coverage of that in the morning. Meanwhile, on the close after market, we get some earnings out of Micron. This could be another big read on what's been going on in the big tech space and in the AI space. We'll have full coverage right here on the close.